Hey there guys, it's Brian here, and today I'm going to be going through with you 5 things that I wish I knew when I started trading, right? So if I could go back and do it all over again, and if I had like these 5 tips that I'm going to be sharing right now, I think it will definitely help improve my trading journey, right? Things would be a lot smoother and I wouldn't make a lot of the mistakes that I made before in the past. So luckily for you, I'll be sharing them in this video so you don't have to go through the same mistake, and hopefully you can learn something from it, take away some good tips and pointers. And before I begin, if you like what I've been sharing so far on my channel, then I'll really appreciate it if you can like my video, subscribe to my channel, leave a comment, right? Anything, right? It really helps my channel to get more views out there. Helps the algorithm so that more people can discover my channel and my video, and it just motivates me to keep making these videos for you guys. Okay, so first up is to look at the bigger picture, right? So I know a lot of traders, there's many kind of traders out there. Some of them trade very short time frame, some middle time frame, some of them are investors, so they look at the bigger time frame, right? And what I want to say is that even though some of the traders, intraday traders, they trade very quickly, right? They get into positions, they don't hold the positions overnight, so it would seem to make sense to not look at too big of a time frame, right? They maybe want to trade like 1 minute, 5 minutes, 15 minutes, right? But asking them to look at 1 day or 1 week, 1 month, it might not make too much sense. And to a certain extent, that is true, but why I recommend to still look at the overall picture and look at the higher time frame is that because you've got to understand that the market, right, moves in trends, right? There are going to be different trends, different phases, consolidation, whether it's trending or it's ranging, right? Whether it's in like a manic phase, where it goes parabolic, all of these different phases of the market. And there's also fractals in the market, which means in a bigger trend, in one big trend, there's going to be multiple smaller trends, and within those, there's going to be smaller as well. So by looking at the overall bigger time frame, for even though you're trading on like a very short intraday basis, it at least lets you have a perspective of where you are currently in that trend, in the bigger trend, right? So for example, if you are just trading, say, in a very short time frame, right, you think you should go short because currently you are looking at perhaps say 5 minutes and it looks like going short is a good idea, right? Your technical indicators, maybe say like your MA crossover, right, is showing that you should be shorting. But sometimes and then if you just base it off of that and then you enter to a short, what happened is that maybe you, in the short term, like in the next maybe 5 to 30 minutes, it does go down, and that's good. And if you take profit within this time frame, you are good to go. But if you are not sure, you don't have a clear exit plan, right, your take profit or stop loss, then what can happen is that after 30 minutes onwards, right, maybe within a few hours, prices starts to go back up, and then it can even go higher than your original entry point. So the reason for this is that in the shorter time frame, the market is in a downward movement, but then in the overall bigger time frame, this downward movement is actually just a minor correction in the uptrend. So if you never look at the bigger picture and you just enter based on what you're seeing in the short time frame, there's a lot of noise, and you can get kind of blinded to what's really going on out there, right? So it's something that's good to know, right, at the back of your mind, at least have a clearer picture of what's really going on. So that's tip number 1, right? Look at the bigger picture. And tip number 2 would be to know the fundamentals and the news relating to what you are trading, right? So I know there's things like efficient market hypothesis that says like everything is discounted into the price, right? Like price is the ultimate reflection of everything out there, and to a certain extent that's true as well. But what I mean by knowing the fundamental of the news is that the price, you only know historical price and the current price. As it's going to be likely almost impossible to know for certain the price in the future. Sure, you may know, whether it's there's a bullish bias or a bearish bias, but it's going to be very hard. So because of that, if you're just relying on the price alone, you can only look backwards, and it's going to be a little bit hard to look forward. But if you take into account things like fundamentals and news, you have more information to go on by to make your decisions, right? To make your trading decisions, you can make a more well-informed decision, right? And fundamental can mean a lot of things, right? To the bigger picture, it could be just like the market they are trading, whether US market or even bigger, right? Like the type, whether it's stocks, crypto, forex, right? So it's good to know that how these asset classes behave, so that when something happens, you know whether is it expected or there's like something wrong, right? Like this shouldn't be happening, right? You should investigate further. And so each asset classes will have their own behavior, and within each asset classes they have different markets as well, right? Like for equities, you've got the US market, very big market. So typically the US market is going to behave differently from, say, like a smaller market in Asia, right? Maybe, for example, a less mature market like Korea. It's kind of the same as how the large cap stocks, right? Stocks you can find in the indexes, right? Like S&P 500. Those are big, very liquid stocks. They're going to behave differently from penny stocks, which is priced very cheap and don't have much liquidity, right? So by knowing what you are trading, right, and not just like looking at the price alone, you can get a lot more insights into it, right? For example, liquidity, right? The benefits of large cap is that you can go in and out very easily without not much slippage, right? When you want to sell, you know there's going to be buyers at the other end, right? But this might not be the case for penny stocks or maybe some low cap crypto, right? Some random altcoin, right? In those cases, if you have a lot of it, then if you want to unload all of them at the same time, then you might not be able to find a buyer for it at the current price, right? By the time you finish selling everything you've got, price would have moved down by a lot more, right? And then so for that cases, in that scenario, you've got to think of different strategies, right? Maybe you don't sell it off all in one big chunk. You could like split them up into multiple smaller orders, right? Yeah, and this can be a time weighted average price or a volume weighted average price, right? There's many multiple ways to slice up orders, right? And also, why you look at the news is that it lets you know if the recent price move in the market for whatever you're trading was due to some news release or it's just random noise, right? So this can be the difference between buying the dip or trying to catch a falling knife. What I mean by this is that if it is due to a news release, right, then the price that you see in the market, it can because of the news release, it can cause a momentum for price to continue in that direction, because there's a substantial reason and rationale behind that move, right? And if it is just a random noise, prices sometimes they can drop down a lot very quickly, but if there's no real good reason for it, it's just random noise. What most often will happen is that the price will revert back to the mean, right? So if it drops, then very, very quickly it just go back up. So that can be the difference between trying to buy the dip or can be trying to catch a falling knife, where the news release is something devastating and the price there's a regime change, right? Another reason why knowing the news is important is that it lets you anticipate where there will be volatility in the future when there is major news releases coming up, because a lot of these news or releases, they are announced in advance. So traders out there will be anticipating and waiting for the news to come out, and then they'll trade on the news. So based on say for instance the forecast of the interest rate, and when the news actually release the interest rate, so from there you can see whether it's lower or higher than what's expected, right? So because of the difference, they'll cause the change in price, and this can be very very drastic. So there's multiple ways this can play out. If you want to trade off it, you can get ready for when the news comes out, and then right there, right, enter quickly your trade. Or if you want to be on the safer side, you can place an order so that you can catch the price, right? Because sometimes it can be very volatile, price move very quickly, and by the time you enter the trade, if you do it manually, the price could have shifted a whole lot more, right? So you might not be able to enter at the price that you wanted, right? And because there's a lot of volatility involved, what you can do is that you can also prepare to hedge yourself, right? Use some things like maybe the VIX, right? Or you can exit your position entirely, right? If you don't want to go through this volatility, right? And what you can by using the VIX or something else to hedge, what you can do is that if you don't want to, if you don't want to exit your position, right? Maybe you want to hold it on for the long term, but you don't want to get affected by this news. Then by hedging, you can smoothen out the effects of it, right? Because if price increase by a lot, if you are short, then you got to find some way to make up for that difference, right? The losses temporarily if you don't exit, and all of this can help for that. Number 3, next up is have an exit plan, right? And this is gonna depend on your trading style, but I'll say that no matter what your trading style, whether you're scalping, intraday trading, swing trading, or whatever, is important to have an exit plan, right? An exit plan is gonna do a few things, right? It can come in different forms. So it doesn't have to, when I say exit plan, it doesn't have to be just say like have a stop loss or a take profit, right? Those are static stop loss or static take profit, so it can be one form of it. Another one would be a dynamic stop loss. So this will not be, say, like if you're trading forex, it might not be, say, 50 pips and then you are out, right? It could be something that's dynamic, right? Maybe instead of a strict pips, you could use something like a ATR, right, which is dynamic, right, and it's based on the current market volatility. So if the market is more volatile, you have a more you set a looser stop, because you don't want to get stop out too easily, right? And if there's not much market movement, like the market isn't too volatile, then you'll automatically set a tighter stop loss, because there's no real reason for you to set too loose, right? Because the market isn't moving that much anyway, right? So that's dynamic, or it could be in the form of your indicators, like moving average. Like for example, if you are long, and then if your 50-day moving average crosses below 200-day, right? That's a death cross, pretty bad if you are long. So if that happens, then you can use that as your stop loss or exit plan, right? It's dynamic. Next could be the exit rule. So it's similar to what I mentioned earlier, indicator based, or it could even be time based. So what I mean by time based is that you could give yourself, say for example, you enter this trade, you think it's bullish, right? You are trading intraday, and you could give yourself, okay, within say the next 1 hour, if it doesn't do what you expect it to do, then you exit. So this could be like, say you are bullish, you go long, and then if it doesn't increase by more than 20 pips, right, then you have a bad feeling about it. It starts consolidating, and then what this means is that maybe your initial assessment might not be accurate, might not be a very strong bullish signal, and if you exit, then you could free up some capital, and then you could use it to look for other entries instead of getting that margin or that cash stuck in that trade, and then you are not sure whether it's gonna play out. Next would be based on portfolio performance. So this applies more if you are managing multiple positions, or you're holding multiple stocks, right? So this could be, for example, like exit if your portfolio is down by 5% or 10%, right? And this is based off the entire portfolio and not just the any single position or stocks that you are holding. So this is more of a overall big picture risk management perspective, where if you have where you can set your own risk tolerance and risk appetite. Say, if portfolio is down more than 5%, like in a day, something is wrong, right? Because your trading style for the past months or years, it's never happened before. So this is something that's not expected, and it's not within the norm of your trading style, right? So it could be like a black swan event, everything is collapsing and you are long everything. So in that case, it makes sense that you want to exit when your portfolio is down 5%, because if you don't, then it could be down a whole lot more. Yeah, so in this case, that's one of the method to plan your exit, which is performance based. And psychologically, it is also easier to cut your losses before they get even bigger, right? You can have a lot of biases come in, you might start to think that if you hold on a little longer, it might bounce back up, and this can be something that's very dangerous, because if you don't know what's causing the price to go down, then it might not come up, right? It might go down even more. And the next reason is that it frees up your resources from holding losing positions, right? I think I mentioned this earlier, and this is good if you don't use margin. So whatever cash you have is gonna be important, because you don't have a lot of spare cash to go into other positions as compared to, say, if you're using margin, right? Because if you don't use a lot of leverage, then you won't have as much free cash to enter into positions. Tip number 4 is don't get emotionally attached to your trades, right? Because this can easily destroy your confidence if you get affected by losing trades, right? This can affect your performance for the day, because if your mood is down and then you start to get too emotional, you can't think straight, you start panicking, and then everything just goes wrong from there. So it's very important that you've got to remain calm, level-headed, and still be able to analyze properly even if you lose, right? Or even if you win, right? Because this is also where two of the most dangerous things in trading can get to you, which is fear and greed, right? If fear is pretty self-explanatory, right? Because if you're scared, then you can cut losses too quickly, because you are fearful that you're going to lose a whole lot more and because you cut too quickly, you might not give it a chance to recover, right? So there's a delicate balance, and it's the same on the upside as well, where if you are using a trend following strategy, right, if you are too fearful, you can have the temptation to take profit, right? Because you might think like, I've been losing so much, right? Any profit now is good, but in this case, there's a very bad way to go about it, because for trend following strategies, most of your profits are going to come from very few big winners, right? And for those to happen, you've got to let those trades ride out the trend and get a big profit. So if you are afraid that you might turn around, then you'll exit your position, and it'll be very, very hard for you to hold on to that position open for long to ride out the trend. And for greed also it's pretty similar as well, because you could get too greedy and you could use too much leverage, right? You could over leverage, and then what happens is that a few bad trade can easily take you out if you over leverage, right? So that's where being too greedy can mess with your trading, right? It can affect your risk management, right? Because if you risk more and you are greedy, you want bigger profits, that also mean that you at the same time you're gonna have the risk of losing more as well. Yep. And typically easy way to counter all of this is that you are usually trading too big if it affects you, right? So what you can do is that you can scale down your trade size, right? So that even if you lose, it's no big deal, right? Because you might lose like 0.5% of your portfolio, or 0.02, right? So it's such a small amount that it doesn't really affect you that much. So like as a general rule of is that if you are losing sleep, or when you are trying to sleep and you can't sleep because you are too worried about what's gonna happen to your trade, then very likely you are trading too big, and you've got to scale down, right? Either diversify your trades, right? Instead of like putting everything in that one stock, right? Going all in, you can diversify your positions into a few different ones, so that there's gonna be a lower chance that all of them are gonna go bad at the same time, right? So you diversify and lower your risk. And lastly, last tip number 5 is to review and learn from the past trade. And this is pretty important, because it lets you learn what's working well and what's not, right? And you can see that is the result of the trade expected, or is it different from how it should be, right? You can sort of go into like a debug mode to go back and then go through everything and then see if there's any strange thing that's going on, right? That shouldn't be happening. Start to look for outliers, right? So if you do a detailed analysis of your trades, this could be, for example, you find that 70% of your trades fall between, say, like $0 to $1,000 loss, and then maybe there's like 1 to 5% where you lose a lot, like maybe 10 to 15,000. So if this is the case, then I would consider that the end is something that doesn't happen very often, but because it could be that you never set your stop loss properly, or there's a very volatile event like some black swan event, and you don't have any exit plan or risk management to stop those from happening, then that's why they happen. They don't happen very often, but they still do happen. So how you can improve this is that you could in that scenario you analyze, say, like it's very rare that those things happen and it should not happen. So what you can do is to have stop loss in place where you don't exceed those amount, right? Because from your past trading history, majority of your trades fall between 0 and 5,000, for example. Yeah, so that's where you should that's where you know that those losses are normal, and there's no real benefit or reward to letting it go beyond that, right? Yeah, so that's one way. And why you should learn from the trades is that you can see which trades work well and which one don't, so that you can adjust and stop repeating your mistake over and over, right? If you know that, for example, you're not someone who can do trend following, right? You don't have the patience for it, right? And then after that style is not working out for some time, it's time to start looking to other trading styles, right? Right, instead of just going at it. And if you still want to stick to it, then you've got to make some adjustment to make it work. Otherwise, you're just throwing money away and doing the same thing that's not working, and that's bad. Yep. So I hope these 5 tips help you in your trading, right? I know they're very important tips for me, and yeah, if you like what I've shared, then subscribe to my channel, like my video, leave a comment. I really appreciate it. Yeah, and see you guys.